and on average, it's about 10% a month.
My guest today balances running a doctor's office with options trading, and he has done very well with his trading so far. Today, he will present his latest zero DTE strategy called Adaptive Butterfly. Welcome, Azhar Pasha.
Thank you.
Give us the 40-second version of your zero DTE strategy and how it is working for you.
So basically, I've been trading the 0DT SPX credit spreads for the past 5 years. However, when things go bad, when the market moves strongly against you, even having a credit spread does not protect you completely, and it can lead to large losses. So what I came up with the strategy is to have a broken wing butterfly on the put side or on the call side, depending on the trend of the day, in which you have one debit spread facing the market, and then you have two credit spreads out of the money. In that way, if the market moves against you, you have some protection. And then the goal is to be able to flip the put spread into a call spread, or vice versa, if the market moves against you.
And this has been going very well for you so far, I understand.
Yes, sir. So I've been doing it for about 3 months now, and I've been averaging about 10% results a month, being very conservative and using a smaller portion of my account with the goal of being, to go to all cash every night. So any rolling involved does not roll to the next day. It is only rolled same day, and having the debit spread facing the market as protection has really helped with that, because as the credit spread gets in a loss, the debit spreads, they go into profit, and they act as a shield to protect against market action if it goes against you.
I'm very eager to get into the details of this strategy, but first tell us a little bit about yourself.
So I'm a physician. I've been in private practice for the past 22 years. I'm an anesthesiologist, but I focus on the interventional pain procedures. I was always interested in the stock market. I started buying stocks when I was in med school in the 90s. I've been doing some sort of option trading at least full time for the past 5 years. And I normally sell premium. So I normally sell options. Of course, if I do a spread, I would buy the option too. But so the idea is to sell premium to generate any profits. I still practice medicine 2 days a week. I've been phasing out that part of my life, and I'm focusing more and more on the trading.
That must mean that your trading is going quite well then.
Yes, sir. I've been very fortunate, and I've been I've been getting good results with the trading for the past 3 years, which has given me the confidence to scale down my 9 to 5 job.
So let's dig into your latest strategy, zero DTE Adaptive Butterfly. What are you trying to achieve with this strategy?
So the idea is to sell premium, and for the 0DTE, most people either sell a put spread, a call spread, or they sell the iron condor. And the idea is to sell premium and to be able to close or to let it expire out of the money the same day to generate some degree of profit. And that's what I've been trying to do for the past 5 years. However, one bad day in the market can erase months of gains, and the market can move really fast against you. So the idea that I came up with, but with trial and error, which is not new, is to have a broken wing butterfly in which you are selling two out of the money credit spreads while you're buying one more towards the money debit spread. And the debit spreads acts as protection, If everything goes according to plan, you're able to close the credit spreads for the least amount of debit, and then you can sell the debit spread back, and that takes away some of the debit that you had to use to close it. And the idea or the goal is to sell premium and to be able to go to all cash by the end of the day. I also have not learned to look at the gamma flows, in which you can look at the live market data. There are a lot of many websites now who sell that data, and it can show you in real time what the market maker positioning is as compared to the customer positioning, and that can lead to identification of the resistance and the support levels. And the way I think about it is that if the market makers are long at a certain strike by a large amount, that means is when the market moves away from them, they have to balance it, so they sell. Now when the market moves towards them, they have to balance to stay neutral, and they buy. So very simply, those levels can be very helpful in trying to predict market action. And of course, they change during the day. And that is why it is imperative to look at live data during the day. And of course, they are also affected by the market price.
So we will dig into the details, but maybe we first should bring up an example so that everyone is clear about what a trade like this would look like. Here you have set up an example trade in options strat. Please tell us what we see.
Yes, sir. So today it is pre-market. So the market currently is trading around 66.20. So if the market opened right this minute, I would sell so I would buy the 6600 put, and I will buy one. Then I will sell three of the 6590 puts, and then I would buy two of the 6570 puts. So essentially, I'll have a debit spread 6600, 6590 that will be protecting the two credit spreads behind it. In that way, I will start off with a credit, and I do realize that I'm giving up some of the credit received by buying the debit spread, which is closer to the money. But I have felt that it really helps in protecting the strategy. It is a credit spread, and the short strikes will go in the money if the market falls below 65.90.
Would you like to collect income from options every week with defined risk? That's exactly what 3 traders are going to show us in the next Theta Live on November 5th. We are bringing together 3 options traders who each have built consistent income systems, all powered by Theta. First up, Simon Black, creator of the Time Flies strategy, a smart twist on butterflies and diagonals.
So my goal for the year is 100% return.
Then it is Steve Gans with his Flagonal strategy, seeing a very high win rate.
If we go up and volatility drops, the butterfly's making money for me. If the market goes down and volatility increases, the diagonal's making money for me.
And Ravish Ahuja with his double calendar strategy.
If I were to just trade double calendar in an account, I can make well over 100% annually.
3 unique ways to turn time decay into consistent income. And you can ask them all your questions. Don't miss this Theta Live. It's going to be filled with actionable ideas. Check out the link on the screen and register now. See you on November 5th. Let's go into your entry mechanics.
I do these on SPX, 0DTE. I use a platform that would let me enter pre-market. So the entry times are normally early in the morning, either pre-market or at market open. The idea is to do it at market open or earlier to maximize the implied volatility and to get the most premium, because that would be the goal while you're selling premium. I like to buy the first strike facing the market between 10 or 5 delta, and that is normally determined by the gamma exposure levels that I mentioned. The 5 delta or the 10 delta coincides with the market maker long. That would be ideal, because in my experience, even if the market moves against me and goes to that strike, most likely due to the market maker hedging, the market will bounce back up in the case of the put strike, or come back down in case of the call strike. So the goal is to enter a 5 or 10 delta for the long strike, and then I go 10 points lower for the short strikes, and then I normally go 20 or 15 points further out for the two long strikes. And it is important to have the two long strikes further away for it to be a broken wing butterfly to obtain the credit.
And you do this for a net credit. You pay for the debit spread, but get premium for the two credit spreads. How much net premium do you usually collect for one position?
I try not to enter a position for less than 40 cents credit.
Are there other conditions that needs to be in place before you open this trade?
Not necessarily. I try to keep it very simple. So basically, the goal is to enter either pre-market or at market open to maximize the implied volatility of the options and to look at the gamma exposure. To me, that is the most important factor. As I think some of the listeners may be aware, there are small hedge funds now which specialize in the 0DTE iron condors. People have different nicknames for them, but anyway, so sometimes they enter the day before at market close for the next day. There's also like a group or a hedge fund that enter 15 minutes after the market opens with very large positions for iron condors on both sides of the market. To mention that is that normally if they have 15,000 or 20,000 positions for a credit spread, either on the put side or the call side, most of the time in like normal market conditions, they act as price resistance and support levels. So if they are in the market, that helps me in finding the levels. And in my experience, if I can be slightly out of the money you compared to their strikes, it almost turns into a foolproof trade, because even if the market moves against my strategy, they act as a protection for a while, and that gives me enough time to do the adaptive part of my strategy. Because if I know that the market is moving against me, but I have a little bit of room, I can monetize the debit spread and use that to be able to flip the direction of my credit spreads.
Azhar, I'm curious about how you look at the market makers level. What tools are you using for this? And maybe we could look at an example.
So this is like one of the platforms that I use. So this is the gamma exposure of the market. And very simply, on the right side of the line, these are the market maker long gamma exposure. And on the left side is the customer long exposure. So very simply thinking, that the left side is like a magnet. So if there's a big position on the left side, which is the customer long, the market is attracted towards it, moves towards it, if it's big enough, and we are close enough to it in the orbit. But however, on the right side are the market maker long gamma exposure. And as we know, that the market maker has to stay neutral at all times just to hedge their positions. So if the market goes up and it goes close to their long position, they have to stay neutral by selling ES futures. So very simply, the market maker long gamma exposure, which is shown on the right side of this line, that acts as a resistance if the market is moving up, and it acts as a support level if the market is moving down. So that how it helps me is that I would like to position my long strike at the market maker long strike. In that way, my debit spread is there. Even if the market moves against my position, it gets to my long. Most of the time, the market maker positioning will act as a barrier, and it will protect it from going into the money. Sometimes it can overshoot and go in the money by a few points, but most of the time it does not slice through it right away. It provides some time, which gives me the grace period that I can adjust my credit spreads, which are further out of the money. And most of the time, like what happened on last Friday, when there is a drop in the market, which is precipitous, I was able to flip my put spreads into 0 DTE call spreads out of the money. And I was able to do that by using the profit that I had generated from the debit spreads, which were further closer to the market. And they went into profit because the market came down.
Can you be a bit more specific about how you did this flip from your put side to the call side?
Yes. So on Friday, I had a 66.70, 66.50 credit spread, two of them. And then I had a 66.70, 66.80 debit spread, which were sold in the morning for a credit of, I believe, 40 cents. And in the ideal scenario, I would have been able to close the whole position either for 10 cents or a 5 cents debit if the market had stayed out of the money. And normally that can happen about 2 hours or 2.5 hours into the trading day. That's the ideal situation. However, around, 90 minutes into the market day, when the market started falling so severely, of course, it was still at 6,700, but it was falling, and the VIX was above 19 or 20 at that point. I was able to flip my credit spread into a 6,700, 6,720 call credit spread. And I was able to do that at a credit when I also sold my 66.80, 66.70 debit spread, which was now worth, I believe, $2 in credit when I sold it back. So in that way, it added the level of protection that I was looking for. And instead of the market slicing through my position and me having a full loss, or have like a stop loss of 3 times credit received, as most people do, I was able to use this strategy to go on the opposite direction, which proved to be, the right strategy for last Friday, because the market kept dropping and my call spread was not threatened and it expired for full profit.
How would you describe your rules for managing this trade?
I would enter it, like I mentioned, pre-market or right at market open. I'm trying to get at least 40 cents credit or higher, depending on my strikes based on the gamma positioning. As soon as my order is filled, I put a close order for my short spread, in which it's a credit spread that I sold. I try to close it for 10 cents. If it closes for 10 cents debit, then I try to sell my debit spread for at least 5 cents. Sometimes, if the market moves towards my strikes, I'm able to close that for 15 cents or 10 cents. So essentially, I'm able to close the whole spread for no debit. So that is the ideal scenario. If the market moves against me, as I mentioned last Friday, I do the adaptive flip of my credit spreads first. And of course, I try to go to a strike on the other side. Like I move my, like the put spreads to the call spread, but I try to move them to a level which, according to the gamma positioning, would be a market maker level, so that would act as some resistance. I need to do that first if the market is moving against me quickly. After I'm done with that, then I'd go back and I try to monetize the debit spread and try to salvage as much profit as possible. The goal is to be positive for the day on the credits received, even with the adjustments. And also, the other goal is to go to all cash positioning every night.
You said that you usually put up a put, broken winged butterfly, but sometimes you also do it on the call side, in open on the call side. When do you do that?
So I try to do one side at a time. And the idea or the philosophy behind it is that, based on price action pre-market, price, you based on the dollar, you based on the 10-year note, there's a bias every morning that the market has, and similarly I have, whether it's going to be a green day or a red day. So I try to go with the trend. If the market is up and it is a green day, which we are expecting, I would enter the put spreads. And if the market is down and we are expecting a red day, then I would enter a call spread. I try not to go counter trend with these strategies just because the market has been so strong, especially right now. As they say, the pain trade is to the upside. So if anybody who's been trying to short the market since April has been losing money for most for most of the time. So I try not to go against the trend of the market, at least starting off. Of course, the market can reverse intraday, and then the adaptive part comes in. Then I have to switch sides, so to speak, and go to the other side. And of course, there are some days which are a chop fest, so to speak, and the market can turn again. And then now this time I don't have the debit spread to protect me. So then, depending on where I am, I may have to flip again, but that's not ideal. And sometimes, if I do that, I may have to increase the number of contracts to stay positive or to get a credit.
Let's talk about the risk. What is the worst that can happen with this strategy?
What the worst can happen is that if the market moves against you and you were away from the desk or you were not paying attention, and it slices through your long strike on your credit spread, you have booked at least 50% loss, because it's not 100% loss, because the debit spread would be completely in the money. So one debit spread completely in the money will help you with the two credit spreads completely in the money. your loss would be 50% instead of 100%. But as everybody who trades SPX knows that you can't walk away from the market. Like even if you go somewhere or walk somewhere to the other room, you probably are watching the market action on your phone. So try not to let that happen. But it's possible that you can not be paying attention and the market moves completely against you, and then you have a 50% loss.
I like to ask my guests to place their strategy on a risk profile scale from 1 being very low risk and 10 being very high risk. And you can define these numbers as you see fit. Where would you put your strategy?
I think this is 4. I say that because I would say that selling credit spreads on SPX would be a 8 or a 9, because one bad day with a complete loss or stop losses that don't work can wipe out months of profits and cause huge drawdowns. But with this strategy, if you're able to pay attention to market action and not let it slice through both of your spreads, it does provide you some protection that would help you manage it, whether you manage it for 0 DTE spreads or you roll it to the next day. Having the debit spread closer to the market does provide you extra protection.
I'm sure everyone now is curious about your results from trading this strategy so far. You have traded it for around 3 months. What have been your results and how do you measure it?
So I basically use IBKR, and they have a very good reporting system that you can do. You can use the portfolio analyst and do daily reports. And that's the first thing I do every morning to run a report for the, for the last day and for my, since I started the strategy. And so over the last 3 months, I've had one day that I had 0.01 loss, 0.01% loss. And that was because I did not close a debit spread. So I try to average at least 39, 40, 45 basis points a day. Some days are less, some days are more. And on average, it's about 10% a month.
And this is measured on your account size.
Right.
How much of your account are you using as buying power?
So I start off using about 20% of my account every morning with this strategy. And I do 20% because if I have to do the flip and I have to manage it intraday, like I said, if I have to do the second flip because of market action, I have to increase the size of my trade by adding more contracts. So I've seen that if I start off by using 20% of my account, it gives me the flexibility to add more of the trades in order to manage it intraday.
And in total for these 3 months, how much is your account up with this strategy?
The account size was 106,000. I think that was the minimum in order to get portfolio margin at IBKR for this account. And I believe it is up around 30,000.
That's quite impressive.
Thank you.
So let's sum up. Who is this strategy best suited for? And what would you say are the 3 to 4 most important takeaways that our viewers should bring with them?
I believe this is not for somebody who cannot be looking at the market. If you're busy at work, so the days that I am practicing medicine, I do not do this strategy. Because
that's reassuring.
Right, of course, for trading and for my patients, because this is not something you can set and forget. This requires attention and the ability to act, to manage. So I would say that this is for people who are able to pay attention, so they're day trading, so to speak. So that's the first thing. The second thing is you have to be careful about your account size and how much you're risking. Like I mentioned, I start off the day with only 20% of my account at risk, because that gives you the flexibility that you can manage it successfully during the day. without having some issues as far as being close to the margin call or anything like that. So that's all very important. Number three, it's very important to look at the gamma exposure and look at the market maker positioning. I believe if anybody trades 0DT SPX and they're not looking at that, they're flying blind. Unfortunately, it can work in the short term, but long term, if you plan to do this, you have to look at that, because that essentially is sort of like an MRI of the market, gives you the underlying positioning and where the market should go. But of course, you also have to pay attention to the headlines, because we live in a time where there is headline risk. One headline during the trading day could completely change the market for the day. So whether you like it or not, you have to be paying attention to the headline risk. You have to know the Fed speakers are speaking, who are speaking today, or if there is a major, global event happening. Of course, there are some things you cannot predict intraday, but you have to pay attention.
We are only one presidential tweet away from everything changing, right?
Of course.
How does your adaptive butterfly fit with the other option strategies you are trading?
I sell premium. So I sell weekly premium on other stocks, and I also do the 45 DTE premium. I also do options on gold futures and crude oil futures. Most of them, I can also employ the same strategy there, but I felt that it is the adaptive butterfly is most helpful with the SPX, just because the price action is so volatile that you need the extra protection. But I have used the broken wing butterfly strategy on other index options and other stocks and futures that I trade.
What would be good resources to learn more, both about this strategy or similar strategies, but also about options trading in general?
Right. So there's a lot of information on the internet. There are a lot of videos. I follow your channel, and what I like about your channel, obviously, is that you focus on the strategy. So if you watch a video, you're going to learn a strategy. Of course, Tastytrade also has some good educational videos. So if I am curious about a strategy, my go-to source would be YouTube, and look at the various videos and then try to make a trade plan. Write it down yourself and analyze it yourself to see if that makes sense and how you would manage it yourself. Of course, you can feed that what you wrote down into a ChatGPT and then ask it to analyze it for you too. But it's always good to make your own trade plan and try to put it down on paper and make some rules for yourself that then you have to keep yourself honest and follow those rules. I believe option trading is like a game of golf, so to speak, because you are the only person that you are really competing against is yourself. It's a mind game. You have to control your emotions and your tendencies, and it's easier to say that. It's easier to know what to do, but when the market is moving against you and there's real money on the line, it's very difficult to keep a balanced mindset about this. So it's very important to trade small and to have a trade plan that you know what you are planning to do and to follow it.
Azhar, thank you very much for sharing your 0DTE adaptive butterfly strategy. And we do have a number of other interviews on this channel about different ways of trading 0DTE. So check those out. Thank you very much.
Yes, thank you so much for having me. I appreciate it.